welcome everybody to another Mariner Wealth Advisors webinar. My name is Jude Grimaldi. I'll be your host this afternoon. I'm joined today by Jodi Robinson and Thomas Hardy. They are two really great speakers today. Jodi is the Managing Director of Tax Planning and Preparation out of our Kansas City office. And then we also have Thomas Hardy. He's a Senior Retirement Plan Advisor out of Tulsa. So both very, very qualified and very experienced on retirement planning and the Secure Act, which is the purpose of our webinar today. Now, before we jump into things, I just wanted to go over a couple housekeeping items. So we do want this to be as engaging as possible. If you do have any questions at all, feel free to submit them inside the Q&A feature that's going to be at the bottom of your screen there. And then towards the end of the webinar today, we will try to get to as many questions as possible. Of course, if you do have any questions after the fact, you can always feel free to reach out to anybody here at Mariner or reach out to your advisor to get any questions that you may have, on the Secure Act and how it may pertain to you. Now, in addition, we do have closed captioning that has been enabled for this webinar. So if you would like that enabled, you can go ahead and click on the CC icon at the bottom of your screen. So as I mentioned, today's webinar is all about the Secure Act. Now, as you may know, the Secure Act is a major piece of legislation that was signed into law with the aim of improving retirement security for American workers. It has significant implications for both employers and employees as it introduces several changes to the rules governing retirement plans and IRAs. Now, whether you're an employer looking to understand the implications of the Secure Act for your offerings or an employee looking to optimize, hopefully we'll be able to provide some insight for you and an overview of some of the key provisions of the legislation and what they mean for you. So let's go ahead and jump in. So let me stop sharing my screen here so you can see all of our faces. And the first question, I will just go ahead and send this over to you, Jodi. So from your words, what is the purpose of the Secure Act and what is its primary goal?
Yeah, so I think the primary goal of the Secure Act is really embedded in the actual title that makes up the acronym Secure. Secure is the acronym for setting every community up for retirement enhancement. So the primary goal of the original Secure Act, which was passed in December of 2019, and then the 2.0 Act enhancement, which was passed in December of 2022, really is to provide incentives and enhancements for individual taxpayers, employees, and employers across all different varieties of retirement plans, whether that's IRAs, employer plans, 401ks, 403bs, SEPs, simples, all of those. You'll find that the Secure Act touches on all of those in some way. And in this webinar, we don't have enough time to possibly cover all of the different enhancements that were made, because the 2.0 itself was 355 or 358 provisions, or 358 pages of provisions. That's a tongue twister. So there's a lot of information in there. We're really going to focus on the ones that are probably primary to our viewers. So a lot more to come.
Awesome, thank you. So I think it's safe to say that if you have some sort of a retirement plan, this is probably something in the Secure Act that's going to pertain to you.
Absolutely.
So Thomas, I'll direct this at you. How does the Secure Act 2.0 differ from its predecessor, the original Secure Act? What are some of the key changes that you're seeing in the new legislation?
Yeah, and I'll start with a few of them here. Of course, we have a lot to cover, and as Jodi mentioned, the number of pages. I think maybe one of the first differences is the number of actual changes, which is somewhere over 90 different actual changes. So again, we could be here for a long time compared to its predecessor, which I believe was closer to around 30 major changes. So a lot of it is going to be expanding on, Secure 2, the first Secure Act, and we'll touch on some of those things. But maybe just to start with some of the things that are changing. I was going to focus maybe just to start out with some of the things that are changing right away. So RMD, so required minimum distributions, that's the age at which you have to start taking a distribution out of a retirement plan. Basically effective this year, that's going to push back from 72 to 73. And then down the road, we have, I think it's about another 10 years. It's going to eventually go to 75. I know we'll touch on RMDs a little bit as we go through. Another thing with RMDs, there used to be a pretty hefty tax if you forgot to take your RMDs. So they've addressed that a little bit. It used to be a 50% tax that's gone down to 25 or possibly 10% if you get it corrected in a quick fashion. That's something that's changed immediately. A few other things you're going to hear us, I think, talk about Roth a lot today. So Roth, get used to that term. A couple things on Roth. Roth matching is now allowed. So if you're, right now, if you're a participant in a retirement plan, typically that goes in as an employer pre-tax contribution. Starting immediately, that can be an after-tax or Roth contribution. The industry still kind of has to figure that one out. So more to come on that, but Roth is kind of being incentivized through all this. So Roth matching contributions are allowed. You're also going to see a Roth catch up for certain individuals in the higher income brackets. So starting, I believe, next year, if you are eligible for a catch-up contribution, of course, catch-ups went up quite a bit this year. They go up more through this Secure Act 2.0. We'll talk about that. But if you make over $145,000, you will have to make your catch-up contribution as a Roth contribution. So that's going to be a tricky thing, I think, for administrators and record keepers to just keep track of. Mm-hmm. So one thing, as we go throughout 2020, this year, 2023, is if your plan does not have a Roth option, which most do, but if your plan does not have a Roth option, you probably want to look at adding a Roth bucket, sometime this year. And then a final one, I'll just point out, it's not Roth related, but something that, kind of small that was changed is employers can now provide small incentives to employees to sign up for a plan. So you might see a little bit more of that, maybe a small gift card or, something like that. So those are just a few that, I know there's a lot that's changed, a lot that's, continuing on, but those are just a few, I think, that I wanted to highlight first.
Awesome. Thank you. Yeah. And we'll dive in a little bit deeper on some of the other provisions that are, inside of this. But while we're on the topic of the Secure Act and how it differs from, 1.0 to 2.0, can we talk about a couple of the things that haven't changed? So what's staying the same? What should people expect to see stay consistent with this new legislation?
Yeah, I'll touch on a few from more of a plan sponsor perspective. I think Jodi will have a few things to add from maybe more individual planning. There's some things on qualified charitable distributions, some extra things with Roths and catch-ups and some individual planning opportunities. But, first one I think is tax credits. So the first round of Secure really provided some really nice tax credits for small employers. Those are usually employers under 50 employees to actually set up a retirement plan. I thought as a retirement advisor, I thought those were really attractive. I think it did move the needle for some small employers. They've basically doubled that. So it used to be a 50% tax credit, and there's a lot of stipulations and, extra things you need to look into with any of these tax credits. But now they've increased that up to 100% tax credit, with some certain stipulations. So just tax credits for small businesses to start up an actual plan. There's also some nice tax credits we're seeing for employer contributions. So for a small business to actually incentivize employers to start up a plan. In some areas of the country, retirement savings plans are becoming mandatory that you have to offer them. So I think this is going to attempt to move the needle as far as, not just having a plan, but, an employer actually providing an employer contribution. So there's some tax incentives that incentivize that. And then, another one is just access to retirement plans. I think, that's a key provision of this is there's a lot of people in America that don't have access to a retirement plan. Mm-hmm. And if they do have access, they're not getting in the plan. So there's some additional provisions that are going to start requiring automatic enrollment and automatic escalation. And that starts down the road a couple of years. Of course, a lot of retirement plans right now, a lot of our clients have auto enrollment features set up. So basically what that does is, you have a group of employees, somebody starts with you. Let's say you have a 3-month eligibility requirement. Instead of that employee having to sign up for the plan, auto enrollment basically forces them to opt out if they don't want to participate. So you set the contribution rate, you set what investments they're going to go into. And then auto escalation is basically a feature where, if you start them at 3% and then they go to 4% the next year and then 5%. So what Secure 2.0 is doing with that is they are going to start requiring that for new plans. There's a few exceptions. but that's something to think about for companies that are starting retirement plans in the future. Also, a couple other things I'll just mention before I stop talking for a little bit, but starter 401k plans. So starter 401k plans is a new provision in there that's it's kind of an easy retirement plan for someone that just wants to offer something. There's just a couple provisions you can pick from, mainly meant for smaller plans, but there are some provisions that allow for what's called a starter 401k plan. It has the IRA limits instead of the 401k limits, so on and so forth. So thing there. And then, another one that's I think tricky for plan sponsors to track, and they've addressed this, regulators have addressed this in the past, but is that whole long-term part-time employee. So somebody that may not meet the eligibility requirements of your plan, if you maybe have 1,000-hour requirements, but they're consistently working for an employer for long period of time and work 700 hours or 800 hours, so they never meet eligibility. So there's some provisions that have previously been added that eventually was going to allow those folks in after 3 years of being a long-term part-time employee, and now that's moving to 2 years in the future. So that's just another way I think that the bill is designed to give people access to retirement plans, and then once they're in the plan, to automatically get them on set for a good savings rate. Sure,
definitely. So Jodi, when we're thinking about the Secure Act and how it kind of pertains to individuals in retirement savings, what are some of the provisions of the Secure Act 2.0 that are going to relate to them and that are going to be important for people to know?
Yeah. So Thomas already touched on the fact that the RMD age has changed. I don't think it hurts to kind of echo that again and maybe kind of walk through how it's changed. So it was 70 and a half, age 70 and a half for years and years and years. And that was the age that you had ingrained in your head was age 70 and a half. The original Secure Act moved that to 72. And now we're at age 73, starting January 1, 2023, this year. And then it moves to age 75, as Thomas said, 10 years from now, which is 1/1 of 2033. So, they've deferred, pushed that back, which is going to allow people, a lot of opportunity for to accumulate more within the IRA instead of having to deplete it sooner. So there's, definitely planning options around that as to whether, you can still take a distribution out prior to that required minimum distribution age. So there's planning opportunities surrounding that for sure.
Yeah, definitely. For somebody that is, let's say somebody was turned 72 last year, and they started taking these RMDs and they're turning 73 at some point this year, do they just continue taking the RMDs that they've already taken, or do they go on a pause and then taking it again?
Yep. So if they turn 72 in 2022, they still have to take their 22 distribution prior to this April 15th deadline. So they may end up taking a couple in 2023 because of that. So
sure.
A few other changes. There was no RMD mandate on Roth IRAs previously, but there was for Roth 401ks. Secure Act 2.0 corrected that. So now there's no RMD requirement if you have a Roth 401k to mirror what was already in place for Roth IRAs. Catch-up contributions. So catch-up contributions have always been part of IRAs or 401k plans, retirement plans for those who are age 50 and above. What the Secure 2.0 Act has done is actually put those on an inflation adjustment annually. So previously, you could, the catch-up could be $6,000 for a couple of years if the IRS chose not to adjust it. Now it's within Secure Act 2.0, it's on an inflation schedule. So we should see that jump up every year for the catch-up contributions for both 401ks, 403bs, any retirement plan plus IRAs.
Sure.
On top of that, there is an even more enhanced catch-up for those aged 60, 61, 62, or 63. So like right before people are approaching traditional retirement age of like age 65, they're going to allow increased catch-up contributions over and above that normal. So the catch-up contribution for 2023 is $7,500. Once this goes into place, if you're in that age bucket of 60 to 63, you're going to be able to do a increased catch-up contribution equal to the greater of $10,000 or 150% of the standard catch-up. So they've really allowed people a small window of time there to do some extra catch-up, before retirement.
Sure.
And then lastly, qualified charitable distributions. So at age 70 and a half, under the Secure Act, you could do $100,000 in lieu of your RMD contribution to charities. And that would decrease your adjusted gross income, provide a lot of benefits. You didn't have to take it as a Schedule A itemized deduction. That is still in place, but it's been now adjusted for inflation. So we'll see that start to tick up annually as well. In addition to that, there's a special election that you can make to do a $50,000 qualified charitable contribution to a split annuity charitable vehicle. Those are typically what you see referred to as CRATs and CRUTs, charitable gift annuity. These are typically charitable entities that you can control yourself. So it gives you a lot more control. I don't necessarily see these being used a lot because there's a $50,000 limitation on it, and these are really very expensive to run administratively. So it's yet to be seen how much this new vehicle gets utilized.
Sure. So thinking about these provisions, and you spoke more on how they are impacting the individuals. So Thomas, I'll direct this one at you. What are some of the provisions of the Secure Act 2.0 and how do they impact employers?
Yeah, there's, I think, quite a few things that impact employers, and some of them are going to cross over, as Jodi kind of mentioned with the additional catch-up contributions. If you're an individual and you work for a company, that's something you might be seeking out. From my seat, we're helping plan sponsors kind of prepare if, how do you actually administer that? And some, as with all these acts, some things are kind of, you try to figure them out, but the why it's 60 to 63 and not 64, I haven't figured that one out yet as far as the ages, but that's kind of a stumper there. But some other things I think to focus on, I guess before I dive into a few things here, is some of these provisions are optional and some of them are mandatory. And then, as we've kind of hinted at with some of these as well, there's so many effective dates into the future. So as I talk through some of these things, there are options to add for plan sponsors, but they may or may not decide to add them, and they have some time to make some decisions. But I think I'll do a little bit of a deep dive here into some distributions, because there's a few things that fall under the distribution umbrella. One thing they've tried to expand on is a problem that we have kind of as a society, which is a lot of folks don't have money saved up for a short-term emergency. So they've put a couple provisions in the Secure Act 2.0 that allow for some emergency savings. There's a provision that will allow up to $2,500 to be saved, and this is an optional provision. I think it starts in 2024. But essentially, if you're a non-highly compensated employee, you could have a vehicle within the plan where you could save up. It's treated similar to a Roth, and then you could take that out for emergencies. So it's kind of a short-term savings vehicle within a retirement plan. Mm-hmm. Another distribution option is they are going to allow a $1,000 penalty-free withdrawal out of a retirement plan. So typically, hardship provisions are subject to a 10% early withdrawal penalty. So they're going to allow a penalty-free withdrawal, and then you can do one, but before you do another one, you have to pay that back. So there's some housekeeping things, some administrative tasks to just keep track of, who's taking those, how do you pay them back. Another interesting thing on that first emergency savings, where the $2,500 thing I'd mentioned, is, if I read the provision right, there's actually a requirement where your first 4 distributions cannot be assessed a withdrawal fee. So you think about it, there is a cost to doing any type of distribution. So I think plan sponsors are going to have to decide, well, are we going to pick up the tab, or are we maybe not going to offer that feature? So some things there. There's also some expanded distribution options for people that are subject to domestic abuse. We saw that similar with First Secure, where they put in some provisions for people that were either having children or adopting children. So domestic abuse victims. Also some expanded distribution options for anybody that is in a federally declared natural disaster area. So that's kind of, I think, a good provision. Another good one, and maybe more of a, I think administrative task for plan sponsors was previously for any hardships, the plan sponsor had to really make sure that the hardship qualified. So if it was for a medical expense or avoid eviction, the plan sponsor had to get that documentation, had to make sure it actually qualified. So going forward, they are going to allow for self-certification of employee hardship withdrawal. So I think that's a good thing. One more thing on distributions. A lot of plan sponsors will force out small balances. So as we sat before Secure 2.0, plan sponsors, if somebody terminated employment and they had under a $5,000 balance, they could be forced out of the retirement plan. They're moving that up to $7,000. So that'll, open up a new series of people that could be forced out of a retirement plan. And then, I think the final thing I'll mention here, not related to distributions, enough on distributions, I think, but for anybody that might be listening that's in the 403B world. So 403B plans, the 401k plans, for the most part have somewhat over the years started to mirror each other, but there are some key differences. One of the things that the Secure 2.0 did address is at least partially getting us down the road to allowing 403B plans to have collective investment trusts or CIT products. That's something that's allowed in 401k space. So that has a little bit more work to do, but there's basically 2 things that had to be changed to allow that to happen, and Secure 2.0 addressed one of those. And 403Bs can also join the pooled employer plan space now, the PEP space. So just a couple things on 403B plans, but yeah, lots more I could talk about, but I'll be quiet for a minute. Since I covered
like we said, what was it? Upwards of 358 pages of provision, so we could be here for days. So we talked a lot about, how this is going to affect those that are in retirement and those that are approaching retirement. And Jodi, I'll ask this one to you. How is this going to affect some of the younger folks that are still a little bit of ways away from retirement?
Yeah, I think a number of the provisions are definitely geared towards the younger employee or the younger retirement crowd. Automatic enrollment in 401k plans, which Thomas touched on already. New plans have requirement to automatically enroll employees. An interesting one added is the student loan repayment match option. So if you've got a lot of younger employees who can't afford to make contributions to their 401k because they're too busy paying off student loan debt, Secure 2.0 now allows an employer to make a contribution, a matching contribution of up to $2,000 for employees who have been making student loan repayments. So their student loan repayments would count essentially as their retirement contribution, and the employer can match it up to $2,000. So that's a nice added benefit. Also, ability to roll over 529 plan assets to a Roth IRA. Some people are fortunate enough to have overfunded 529 plans, whether that's grandparents and parents made mega contributions to 529 accounts. Maybe they got some scholarships, maybe they don't have siblings or cousins that they want to pass those accounts along to, so they're sitting there with funds inside of a 529 plan trying to figure out what to do with them. Well, now they have the ability to roll with certain restrictions, like the plan has to be open, been in place for 15 years, and you can't take contributions out that have been made within the last 5 years, a few other things. But up to $35,000 lifetime max can be rolled over to a Roth IRA. That's 35,000 can't be rolled over all at once. That's still subject to the annual Roth IRA contribution limit. So you would have to do it over a series of time. But it is a nice opportunity to be able to roll some of those 529 plan assets that you have sitting there into a retirement vehicle and begin funding those for younger folks.
Sure.
Thomas touched on some expanded opportunities or circumstances for penalty free withdrawals. The emergency expenses, I think, is a big one. Lots of times people are in a situation where they are caught without cash. They've got money in a retirement account, but don't want to have to take it out, or if they take it out, they're going to be subject to penalty. So this is a nice feature that they've included here for emergency expenses. Roth options now have grown beyond IRAs and 401ks, and now include SEPs and simples as well. And then savers credits. This one's, I think, probably appealing to younger folks as well. If you're making retirement contributions and fit within certain phase out limits, the savers credit used to be just that, a non-refundable credit that you could use on your tax return. Well, that has now flipped to an actual matching contribution from the government to your retirement account. Now, I think Thomas also touched on this. A lot of these things, we still have yet to figure out how they're all going to work. So a lot of these sound really cool features, but how it all gets put into play and how employers are going to get all their plans updated and reporting to government to make these matching contributions and all of that still has yet to be figured out. But there are a number of features included here that I think would be great for the younger generations to pay attention to.
Awesome. We actually did have a question that came in regards to the 529s. Do the kids need to have earned income to have excess 529 funds transferred to their Roth?
That's a really good question. I don't think so in this provision, but we can definitely get back to this person if they want to leave us their contact information.
Yep, definitely. Yeah, and that's a great point, Jodi.
Unless Thomas knows the answer to that.
I don't know the answer. Maybe there's already the answer. That could be one of these things. As you mentioned too, Jodi, we're waiting on clarification on some of these. So how do you make some of these things happen? Yeah. So there may or may not be an answer already, but we'll probably have an answer soon. Yeah.
Yeah, definitely. After we pick apart these 358 pages. No, but Jodi made a great point. If we aren't able to get to your question as we get to the Q&A in a few minutes or so, definitely make sure that you're asking these questions to your advisor. And then if you do want to leave your contact information, you can always reach out to anybody here at Mariner as well, and we can help get any of your questions answered. So I'll just direct this one back at you, Jodi. What is the timeline for the implementation of the Secure Act? I know it kind of varies, but what steps can people take, individuals and employers to prepare for it?
So a lot of these, or a number of these, took place immediately upon enactment, which means 2023 is the effective year for a number of these changes. But there are also ones that go into place in 2024 and in 2025. So it's definitely, something that you want to make sure before you make major, commitments to do something, make sure that you understand the timeline for doing that. That's working with your tax advisor, your wealth advisor, making sure that, you're getting you have the right understanding and that you're getting the timing right on these things, because they are coming into effect over a period of years, not just instantaneously.
Sure. And I might add on that, just maybe from a plan sponsor perspective, it is going to be challenging. I'm hoping that, another 3 years from now, we don't have Secure 3.0 because we have a lot to digest here. But, kind of what I'm seeing is, a lot of the record keeping and the administrative partners we work with, they're still digesting this and they're coming up with plans for plan sponsors to implement, as we kind of go through the following months. So a lot of the administrative folks and record keepers don't have all the answers yet. There's also a provision in there. We saw this with Secure Act. The original one is some of these features you can actually adopt before you do an actual amendment. So we'll see some of that where you might start operating your plan in a certain fashion, and then you amend it after the fact. But I think, a big takeaway is, there's going to be a lot of things to track in the future. So, going back to Jodi touched on the student loan repayment, who's going to track that? How do we make sure they made the payments? These new distribution options. So some of that's going to be on, plan sponsors, the entities that are sponsoring the retirement plan. I also think that payroll companies are going to have a heavy lift here to keep track of all these different dates and who's eligible for what and new catch-up contributions. So, getting in touch with your payroll company probably before the end of the year to see what plan they have. And then, as an advisor, we're here to answer questions and kind of direct folks in the right direction. But, I think it's going to take a team, CPAs, so tax credits for new plans, of course, CPAs are going to be involved. But just kind of, I think my takeaway was, probably start asking questions and assembling the team, as we work through the next few months.
Sure.
So Jude, I did do a quick look up on that Roth IRA question. The beneficiary does have to have earned income, like a normal IRA. So to do that $35,000 conversion, they would have to do that.
Awesome. Thank you. So let's start to jump into some of the Q&A here. There is a ton of questions that did come through. As I mentioned, we're not going to be able to get to everybody's questions. So if we don't get to your question, like I said, make sure you're reaching out to your advisor or any of us here at Mariner. So a couple came in regards to just inherited IRAs. Can one of you speak to just inherited IRAs, whether there's been any changes there or not any changes there?
Well, that's a little broad, but if one popular topic with inherited IRAs is the 10-year rule that came out in the original Secure Act, which says that if you are a non-spouse and inherit an IRA, you have 10 years to basically deplete it. And then the IRS last year came out with there was some potential clarification that said, well, we meant you had to take it out every year and you couldn't just wait until the 10th year and then take it all out. So the IRS at the end of the year then kicked the can down the road and said, we haven't yet officially ruled on that. We were hoping that maybe Secure Act 2.0 would officially clarify that. They did not. So we don't have any further clarification on inherited IRAs, non-spousal inherited IRAs as far as timing of that 10-year rule. So I can't address that question.
Sure. Yeah. So more to come, hopefully.
Yeah, hopefully. I'm sure we'll be sitting here next December with the same issue.
One of the questions came in regards to small businesses and retirement accounts. Will a Roth option be available for like a Keogh type of retirement account with one person or owner LLC for a small business?
My understanding is yes, with Steps and Simples and all these four. So my understanding is yes. I mean, I know there's a lot of types of retirement accounts out there, so maybe check with your advisor. But that was one of the enhancements that some of those smaller types of plans that previously were just pre-tax do now allow for a Roth option.
Right.
A couple questions came in regards to QCDs. Is there any changes to the annual max qualified charitable distribution?
So it's still the $100,000 for this year. Beginning with next year, that will be adjusted for inflation every year. So it'll go up by whatever that factor is each year.
Sure. And then is there an AGI limit for a QCD?
No.
Just a gross income. Okay, awesome.
which is one of the great benefits of it.
Right.
Because you can also use it to, kind of do some planning and decrease your AGI as well if you had been required to take an RMD.
Definitely really good planning opportunity there.
Mm-hmm.
And I see that a lot with our advisors and our clients.
Yep.
Oh, let's see here. So I'm trying to scan through all of these.
There's some good questions.
So one question came in. Can you discuss the solo 401k plan provision in Secure Act 2.0? Can either of you speak to that?
I would have to look that up. I'm not sure what provision they're referring to exactly, but that'd be, I think, a good one maybe to reach out to whoever your advisor is.
Yeah, definitely. All right, we'll get to one or two more here before we jump off. How will the Secure Act 2.0 impact, a backdoor Roth creation and limits there?
So it actually does not change that opportunity. That was one thing that's been kicked around, as potentially being included in some of these bills, but it's actually still an opportunity for making a backdoor contribution. Hasn't changed at all, other than the amount.
All right, so the last question here, and this is on another specific retirement account type. Did the Secure Act have any impacts to a Stretch IRA that we know of?
No. I mean, it's just the enhanced, catch-up contributions or annual contributions that would be the same.
Sure. Awesome. So a majority of the other questions that are in here are very specific to a lot of personal situations. So I'm just going to say, make sure you're reaching out to your advisor for these questions, as they can get, like we all said, we could be on this for hours and hours on end, digging into the details of these. So I'll just say, for any other questions that did come through, make sure that you are reaching out to your advisor. If you don't have an advisor, of course, you can feel free to reach out to us here. But I will go ahead and just thank, Jodi and Thomas for your time today. It was, this is really great. I learned a lot about Secure Act 2.0 that I didn't know about. And, we do have a ton of resources here at Mariner as well. We have our tax planning guide, our annual tax planning guide. We also have some other Secure Act resources on our website. So you can always feel free to just jump into the Mariner website and just search Secure Act 2.0. We have a podcast episode on that. We have some Secure Act 2.0 changes just listed there. And, there's a ton of resources that we have internally. So if you're not seeing anything, always feel free to reach out. But again, Thomas and Jodi, thank you so much for your time today. And everybody, thank you for spending another hour or so with us.